Realty Income is around its 52-week low, but does that mean it's not worth investing in? Or should you be looking at this company a little bit more closely? Now, if you want to invest in a company, you should definitely know what the company does and if there's any macroeconomic factors that could be affecting the stock price. Because if a big company like Realty Income is down 21% over the year, you're going to be able to kind of guess on what is causing this big decline. So let's take a closer look at Realty Income's business model. Now, Realty Income is classified as a REIT, which stands for a Real Estate Investment Trust. And what this basically means is it's a company that owns or finances income-producing real estate in a variety of sectors like commercial, industrial, retail, residential, etc. Now, because they invest in real estate and produce income, those incomes from those properties are actually converted into dividends that they pay out to their shareholders. Now, the good thing about Realty Income is they actually pay a monthly dividend, and that dividend has been constantly increasing for around 20 years now. And these numbers on Realty Income's website kind of show you just how much the stock pays out in dividends. You can see that there's been a 4.3% annual dividend growth rate since 1994. They have 639 consecutive monthly dividends declared, and then that 104 consecutive quarterly increases. So if you ever spend time looking at dividend stocks to invest in, Realty Income is one that always comes up just because of this high dividend growth, and it pays monthly. Now, what does Realty Income more specifically invest in to give that money to their shareholders? Their main focus is on acquiring freestanding single unit properties under long-term net lease agreements, and then as you can see, they have over 13,100 properties under long-term net lease agreements, and that's in 85 separate industries. And you can see the combined gross real estate book value is $46 billion. And a net lease is where the lessee pays a portion, if not all, of the taxes for that property, maintenance, insurance, and rent for that property. And this is a good business model because Realty Income does not have to worry too much about the maintenance costs for the properties or like the insurance because the tenant is actually paying for that themselves. So Realty Income can focus on acquiring more properties for their business. And on this graph, you can actually see the top 10 industries that Realty Income invests in, with the highest right now being convenience stores, which is at 11.1%, grocery stores, which is at 9.9%, and dollar stores, which are 7.1%. And then if we further break this down, we can actually look at the top 20 clients with big name brands such as Dollar General, Walgreens, CVS, Lowe's, LA Fitness. Now, a good thing about this is that Realty Income, because they diversify so much, they're not exposed to one industry a whole lot, because even the highest industry that Realty Income invests in is only 11% of their whole portfolio. That way, if something goes wrong and a big dip happens in that, they have other industries that they can use to cover that loss. And another great thing about Realty Income and their tenants that they have is that the occupancy rate is very high. And this means that there's a lot more cash flow for the properties, which allows Realty Income to continue paying those monthly dividends. And you can see how high the occupancy rate is from this graph, with it constantly being above a 96% occupancy rate since 1992. So now that we know Realty Income's business model a little bit better, we can kind of see what macroeconomic factors could be causing this big decline that Realty Income is having. Now, to be classified as a REIT, Realty Income needs to pay 90% of their taxable income to their shareholders, and this is in the form of dividend payments. And you would think if they're paying 90% of their income to their shareholders, there wouldn't be a lot of room for growth. But this is not really a factor if you look at the full-time graph of Realty Income, where it's around 400% return since its inception date. So what is another factor that could be at play on why Realty Income is down? And the biggest cause for this is the recent rise in interest rates. Now, because Realty Income gives away 90% of their taxable income to their shareholders, they need to borrow a lot of money in the form of debt to be able to buy these new properties. And since these interest rates have risen, the cost of borrowing money has significantly increased, which obviously affects Realty Income's profitability. Now, the unfortunate news with this is that until those interest rates go down, Realty Income will have a really hard time trying to find new properties to buy since the cost to borrow money is so high right now. And lots of the investors in the market know this, so they're more inclined to take their money out of REITs like Realty Income and put them into other assets that may not be too prone to this interest rate risk. So what does this mean for the stock price? Well, in the short term, it's very volatile to tell where Realty Income could be in the next couple months just because these interest rates could change a lot. If interest rates come down in the long term, Realty Income may be a wise choice as investors could be more likely to put their money back into REITs like Realty Income because they know that that interest rate is going down, which means that Realty Income would be able to borrow more money to have new properties. Thank you very much for watching. If you want to see another breakdown kind of like this, I made another one on SCHD, and you can find that by clicking up here. That's it for now, and I will see you in the next one.